The Senate passed the $1.9 trillion coronavirus relief package on Saturday, sending it back to the House for final approval. And joining us to discuss the impact it'll have on the markets and the economy is Nancy Lazar, partner and co-founder of Cornerstone Macro, and Dan Clifton, head of policy research and managing director at Strategas Research. Good morning to you both. Nancy,
Morning.
This already looked like the economy was getting ready to accelerate. And what does the $1.9 trillion do for GDP this year? I mean, it seems like you have to start to predict boom times.
Oh, I think it is. We just raised our forecast to 9% GDP here for 2021, and that's going to be the strongest growth since 1959. Basically, nobody in the business has ever seen anything as robust as we're going to have today. Obviously, the consumer is going to be a big driver of that. 10% consumer spending this year is not aggressive. The amount of savings that they have, given the additional stimulus checks, consumers, that's going to help boost consumer spending in and of itself, potentially by 20%. I mean, these numbers are surreal. We're using 10. We're assuming they do save some of it, and or it helps the economy as we go into 2022. Capital spending, in addition, we think is going to be very robust. We were already strong in the back half of 2020. Business confidence is going to get a booster shot. We're very bullish on the onshoring manufacturing renaissance theme. Certainly what's going on around the world reinforces those themes. So this is a pretty healthy recovery. But the community, quite frankly, has never seen anything as robust as we're going to potentially have this year.
Well, and the fact that it's so unfamiliar to have these growth rates, Nancy, probably is why there's so much attention on this idea that perhaps there's a risk of overheating, whether that means manifesting in inflation or the Fed having to move. Where do you come down on that?
Well, it certainly is a risk when you grow as quickly as we have today. But again, we did grow almost as fast back in 1983, and you didn't have inflation. Obviously, you were a disinflationary environment. And why was that? Well, we were beginning the upturn in productivity growth in the early 80s, and that obviously continued in the 1990s. Given the investment cycle, capital spending cycle we've seen, which initially was indeed focused on technology, we have a secular shift up in productivity unfolding right now, which we think is one of the biggest underappreciated supports for the economy. And at the same time, there's so much labor market slack, as the Fed has been highlighting. And we think that comes back. We think that labor supply comes back. You see that in the labor force participation rate inching higher. And so that combination of stronger productivity growth and at the same time more labor supply mitigate a sustained shift up in inflation. Cyclically, yes. Secularly, I don't think so.
Dan, Democrats needed pretty much every bit of their majorities in both houses to get this done. Obviously, it's a pretty aggressive fiscal effort at this point. What do you think it says in terms of what investors need to know about policy from here on out, whether it's about infrastructure or the appetite for a more activist fiscal posture?
Yeah, I think there's a couple of key takeaways here. The Democrats unexpectedly had complete control of the government after the Georgia elections. And when you have power, you press your bet and you go for the big package. This is $1.9 trillion. They got everything they wanted. And we're going to do more stimulus this year than we did last year. Last year, we had a 15% unemployment rate. We were approaching lockdowns. Now we have a 6.2% unemployment rate. And we have a reopening that feels almost like the Berlin Wall came down over the last couple of weeks in terms of states reopening. So this is a classic indicator of Washington being a lagging indicator when it comes to the timing of its fiscal policy stimulus. We're going to have more Americans with 2 shots vaccinated today than we have confirmed COVID cases. That's a very, very big deal. As this stimulus starts to come out, consumers will be able to spend their money. I think that's reflected in what Nancy's talking about in her economic forecast. And as interest rates start to normalize here, that's what's going to be the background for this next debate over infrastructure. I can tell you, there's 50 Democrats in the Senate and 222 Democrats in the House who want more infrastructure spending. But the challenge will be keeping everybody together this time around like they did on the first bill, which is much harder to do. How do you pay for it? There's likely going to have to be tax increases. And the reconciliation rules that allowed this bill to pass are much, much tougher as you get into an infrastructure bill. So I would just urge investors that the next round of stimulus won't be as easy as the first round. It may be more wanted by investors, but it also will have to deal with the economic and inflation environment. In the short run, you are going to see price pressures. You can't give out all this money to consumers and think that we're going to have the production to do that. And that's really, even if it's a short-term effect, is going to be the background by which that infrastructure bill is debated. And I think it's going to be a bit of a longer 3 to 6 month type of process that we're going to have to work through. And at times, it's going to look like nothing's going to pass.
Shepard Smith here. Thanks for watching CNBC on YouTube.